Hello, everybody. Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gay, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors. What a week. On Wednesday, the Dow jumped 1,300 points. It was the best single day since April of 2025. After a fragile ceasefire between the U.S. and Iran sent oil prices sharply lower. Then this morning, it's Friday, the March CPI number, the inflation report hit, and it was the hottest inflation reading in nearly 2 years. It was 3.3% was the headline number. Gasoline was up 21% in a single month. Headline inflation was the 3.3% annualized. We also got a jobs report last Friday that blew way past expectations, and there's just a lot to unpack that's happened over the last week. And it's pulling markets in different directions, up, down, sideways. And we're going to break it all down for you today in today's episode. So without further ado, let's jump right in. Let's start with the jobs report last Friday, which was Good Friday. The markets were closed, but the number was 178,000, excuse me. It was the highest jobs report in a single month since December of 2024. The consensus estimate was only for 57,000. And with that being said, the unemployment rate actually ticked down to 4.3%. Healthcare was the leading sector, added more than 76,000 jobs. Heard that most of the uptick in jobs that were added and the downtick in the unemployment rate was from people that are like 50 plus, 60 plus coming back into the
I think we saw, especially during COVID, a lot of people in their late 50s, early 60s decided to go ahead and retire. And maybe they've gotten to the point where they've decided, you know what, okay, it's 4, 5, 6 years removed from COVID. I had my fun, I had some retirement. Now I'd like to get back to doing something more productive. Or maybe they figured out, hey, listen, I might have retired too soon, pulled the trigger too soon, and I need to get back to work. Because as we know, if you are not full retirement age, you are not getting your full Social Security benefit. And if you take it early at 62, you've locked in a lower benefit for life. And that's a problem. And maybe some of those folks have decided, you know what, I need to get back to work because I didn't do as much planning, or I wasn't ready exactly, but I just did what I had to do for the time being. And now I'm looking to come back. And I think a lot of people my age or older have figured out, hey, listen, I still got something to contribute here. Maybe that's what it was.
Well, and I think you bring up a good point that there's a big difference between whether or not that was by choice for those people coming back into the workforce, or if it was because they said, well, I'm not necessarily struggling, or my financial plan, my income plan for retirement didn't get knocked off its horse, but having some supplementary income might help. So it's not that they were forced back into the labor market. Right?
Yeah. It's hard to know exactly because I don't know that that's part of their survey. Why are you coming back to work?
I don't think it is.
I don't think it is. And of course, you and me both know that it's one thing to go back to work because you want to. It's another thing to go back to work because you have to. And the have to part really stinks, especially if you've got a 2 or 3 years under your belt where you haven't been working. But I think in this economy, you're going to run into a lot of people that have decided, you know what, because of higher inflation, higher gas prices, higher oil prices, higher prices across the board, inflation, I've got to go back to work, at least to earn some kind of earnings while I'm doing this thing called life.
Talk about inflation. So the headline number was 3.3%. The estimate was for 3.4%. The market's reaction today was not really up or down. It was more sideways, I would say, which I think that tells you that some of the expectation for inflation being elevated and ticking back up was expected.
For sure. I think you're exactly right. If you look at the market and what it did today after CPI came out this morning, it was very muted, very muted. I think the market has just decided this is going to be temporary. And I think part of the reason why we can say that is that, as you told me this morning, if you look at futures for oil contracts in December.
Yeah.
They're already back down
It was
$70 a barrel.
Yeah, it was like at 70 something a barrel.
Yes. So I think the market in general, across the board in every sector, has decided everything that's going on right now is temporary. Temporary, temporary, temporary. Now, what does temporary mean? Is that 30 days, 60 days, 90 days, 180 days? Hell, I don't know. But I think for now, the market's decided that at least by the end of the year, things will look much better, quote unquote, for oil than they are right now.
S&P 500, we had 5 straight weeks of losses. This week was a meaningful bounce driven almost entirely by the ceasefire optimism, which is a great segue into talk about Iran. But the S&P 500 is at the close of yesterday, because we're about to close out Friday today, but it was at 68.24. That was off of 64.77 from the previous 10-year U.S. Treasury yield, which we like to talk a lot about, is at 4.31%, which is slightly off the 9-month high of 4.39. So it's been up there, and we've been talking about that thing for a while because we like to watch that. It's a good barometer for a lot of other interest rates out there, namely mortgage rates. And then finally, the VIX, which is our measure of volatility. I think it's in the, let me get the actual level for that. I think it was in the 20s, but it spiked shortly after all the Iran conflict kicked off, but it's currently sitting just under 20 at 19.55. For the week, it is down 21%. Let's transition and talk about the ceasefire, all the conflict that's going on in the Middle East, and how that's really affecting markets. We obviously know that oil's price has spiked substantially, even though it's come back down like we were just talking about. That's been the main driver for some of the geopolitical concerns, I think, namely inflation.
Well, I'd say this. If you think that the events in Iran are over with, I think you might be doing some wishful thinking there.
Might be a little premature.
Might be, because remember, this ceasefire deal is only for 2 weeks. And the Iranians already yesterday were claiming that we had violated the ceasefire agreement. And of course, the administration claimed that, what they were complaining about had nothing to do with the current ceasefire terms that they had negotiated. You kind of almost have to throw your hands up and say, well, I don't believe either one of them. So I would just say, if you're an investor out there and you're thinking about doing something, keep in mind that the volatility ain't over with yet. You should probably expect some more roller coasters riding over the next few weeks, because it doesn't seem to me that anything's really been solved. They've just agreed to pause things. And so if that's the case, you got to be prepared for what happens if the ceasefire falls apart, or nobody gets what they want and they don't agree to extend it. That's really the main thing. So I would say you got to keep those things in mind. Of course, we also want to keep in mind about earnings, because earnings are ultimately what drive stock prices. And yes, inflation, geopolitical events, they're important, especially in the short term. The headlines can drive markets in the short term, but ultimately, the bottom line at the end of the day, it's earnings. And as long as earnings stay nice and don't collapse, we should see, stock prices continue to weather the storm as they usually have over the years.
I'm glad that you mentioned that, because earnings season kicks off next week with the big banks for Q1. And I think that investors, with all the noise out there, I think sometimes investors kind of stray away from remembering that earnings is the fundamentals that back up the actual valuations in the prices in the stock market itself. So this is kind of related to inflation, oil prices being elevated, which means inflation being elevated, but it's a spinoff and a byproduct of that, which means if inflation is elevated, then we would expect interest rates to also remain relatively higher, right, for that time period while inflation remains elevated. And right now, the CME Fed Watch tool has the Fed not cutting anything, or the markets have priced in the expectation that they're not going to cut again between now and the end of the year, which means interest rates will, all things being equal, will probably stay roughly like where they're at, which means us as consumers, if we have liquid emergency funds in a bank account, like in a savings account or CDs, whatever rate that is earning currently, it's might continue to be supported through the end of the year, which is an end result to the end consumer here for your emergency fund. So those rates as a result of oil price increases, inflation maybe being a little higher, interest rates remaining higher, that gives those of us that have those liquid savings in financial institutions potential for better yield during that time period.
For sure. If you're a saver and you're looking to maximize the return that you can get, looks like interest rates are going to be supportive of that. Doesn't look like they're going to go down anytime soon. But if you're a debtor, on the other hand, or a borrower looking to buy a house, buy a car, do some other kind of financing for anything, you can expect to pay a higher rate, probably for an extended period of time. So what I'm saying is, if you are going into debt, keep that in mind. So all the people that have been getting adjustable rate mortgages, you should rethink that, because if interest rates stay elevated, guess what's going to happen when your mortgage adjusts? It's going to go up. Be careful of that. Be mindful of that. Sometimes higher interest rates is the poke in the eye that you need to make sure that you don't overextend yourself, because that's really what that is. It's an incentive or a disincentive to finance a higher balance. In other words, it's an incentive or disincentive to minimize or maximize the amount of debt that you're going into. And if interest rates are going to stay high, which it appears they might be, then you really want to think about going into debt and minimizing how much it is you're going to go into debt for, because the less debt you have, the less interest you'll pay.
Right. And the harder it is for you to grow your net worth. And so what you're saying is this higher interest rate environment might be good for savers, but it might be really tough for borrowers.
Absolutely. Absolutely. Yeah. So you might need to adjust your balance, your mortgage expectations. You might need to adjust how much you're going to put down, whether or not you're going to buy any points off the mortgage. All those things factor into it. So this is a time like no other. Sound like the president. This is a time like no other to.
It's a better time than it has ever been before.
Yes, ever been before. To really think about and be very cautious and careful about what you're doing with your finances, because nobody's going to look at it better than you are for your own self. So be very, very mindful and thoughtful. And remember, don't ask your real estate agent or your mortgage loan officer if you should do this, because guess what? They have an incentive to tell you, oh yeah, man, don't worry about it. It'll be fine. Not that any of them are dishonest or can't really be truthful or impartial, but you need to be able to analyze the things that you're doing for yourself and determine for yourself if it's a good idea. Because I always use the analogy of it's like going to the tire store. If you go to the tire store and you ask the tire salesman if you need tires, he's going to say, hell yes, everybody needs tires, new tires at that. Now, does that mean you need them today? Maybe, maybe not. But you got to be really, really careful about that. It's the same thing buying a car. If you're going to ask your car salesman, should I get this car? What do you think the car salesman is going to tell you? Hell yes, you need to finance this car. Never mind that it's $1,000 a month for 8 years. You'll be fine.
Yeah.
So if you need some help, if you have some concerns, some thoughts, some ideas, hey, is this really a good idea for me? Ask us. We'd be glad to sit down with you and talk to you and give you an impartial answer about what it is that you're thinking of doing. We're not going to tell you what you want to hear. We're going to tell you what you probably need to hear. And you may or may not like what we say, but that's okay. We're not here to, make you feel good. We're here to tell you the truth. And every single dollar of debt that you get into today means one less dollar of wealth that you can build for the future. Yeah. So keep that in mind too.
Well said.
Yeah.
Okay. For next week, the docket, we have retail sales on tap. I think Tuesday, we already mentioned earnings season is going to kick off. We got the big banks kicking us off for earnings season like they always do. We have a University of Michigan consumer sentiment survey. And then towards the end of the month, we have the next Fed meeting. And then we'll obviously continue to to get headlines about what's going on in the Middle East and the developments there. So with that, we will call it a day, and I hope that you guys, in a week, and I hope you guys have a good weekend, and we'll catch you back here next time. Don't forget, interact with us, share our content. We're on Facebook, LinkedIn, and YouTube. Thank you. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.